For the second year in a row, the Vision Opportunity Fund has been named as one of this country's best performing hedge funds. Since it was formed in July of 2008, the fund has produced a total return of more than 69%, and it's done so with a sharp focus on real estate. Joining us in studio is Jeffrey Olin. He's the president and CEO of Vision Capital Corporation. Jeffrey, great to have you back.
Thank you.
You came in for this particular fund for the fourth place out of the top 5 in the country, but it was the only one that didn't use any financial leverage really of any sort. How did you manage that? Why did you go that route?
Well, firstly, the expertise of our team. My partner, Frank Mayer, and I have 60 years of experience in this area, focused on primarily publicly traded real estate equities. Secondly, there's a great opportunity in this country that we see because of an inefficiency in the pricing of these securities, meaning they are often too high or too low relative to where they should be based on their net asset value of the real estate underneath the share price.
Now, it seems to me it's the Vision Opportunity Fund, so it seems to be concentrated 85 to 90% in REITs and real estate. People would have thought the timing, July 2008, things were still falling apart, but that might have been a good time to start looking at it. What have you found in real estate that has allowed you to, besides the disproportionate valuation between what's going on in the market and the underlying assets, has it just been scared money? People have been selling the stuff and you've been there to pick it up?
Well, we've been cautious since inception, and we, as I said, focus primarily on where there's disparities in value versus trading prices. So, for example, our largest holding that we've been there since inception is a company called Parkbridge, PRK, in Toronto. Anybody that would care to listen, we've been telling folks like you that it's our top pick, and 2 weeks ago on Monday, BC Pension Fund announced a takeover at a 30% premium, and it's just indicative of, I mean, the market, Canadians generally, capital markets have had a fervor for yield. We've been seduced by yield, whereas the lower dividend paying and some of the smaller cap companies have been ignored, but that doesn't mean the value isn't there, and this BC transaction with Parkbridge underscores that in spades.
So when you're looking at the REITs for opportunity, you're not looking for yield very clearly, you're looking for underpriced opportunities.
Total return. We do look at yield, but we look at total return.
And are you sticking towards one end of the REIT sector, shopping malls, et cetera, or housing?
Good question. Roughly today, 50% of our holdings are in residential, not single-family residential, but rental residential. Our commercial holdings, we have a significant holding in a company called Edlian, which is a company we love, which is consolidating and building new childcare, daycare centers in Canada. For us, it's reminiscent of our early-stage involvement with other consolidation plays, Boardwalk and Killam, that proved to be 7 to 15 times return on investors' money. It's a great space. That's one of our commercial holdings. Unlike Boardwalk and Killam, which were primarily consolidation plays from a regional base, Edlian is a national platform, and because of the huge disparity with demand exceeding supply, also has the opportunity to build new state-of-the-art childcare centers, and it's also a feel-good investment.
Are these standalone childcare centers, or are they part of a bigger building or a mall or something like that?
Generally, they are standalone. The company just started, although they have a world-class management team that's done this before. They have 20 centers, 17 of them are owned centers on standalone sites where they own the real estate, and that's another piece of it that we like.
Have they done this before, or have they done the roll-up strategy before?
They've done both. The
Okay.
chief operating officer was involved in the largest company in the world in Australia that grew them from 45 centers to 1,100 over 6 years, and the CEO developed corporate childcare centers for large Fortune 1000 type companies in the United States, MGM Grand Hotel, Cessna Aircraft, companies of that nature.
Okay, let's talk about another name here that you like. It's Melcor Developments. What is their specialty?
Melcor is a land development and income property owning company based in Alberta. This company has been around since 1922, been public since 1969, and it's trading today about 50% of its net asset value. So it goes back to those inefficiencies that the Parkbridge transaction highlighted. We think the market is not pricing this well, doesn't understand it well, and there's some catalysts here. One being IFRS, which is coming out, International Financial Reporting Standards, which will start to highlight in spotlight the values of these entities, notwithstanding where the share price is trading. So we like this company a lot. It's also misunderstood because it reports on earnings, not cash flow, whereas most real estate entities report on cash flow. And because they have a significant income property portfolio, it should, in our opinion, be looking at reporting cash flow so it can be better assessed and better compared to other entities.
So will IFRS make them report on a cash flow basis? I mean, it's easy, or is it easy to calculate what their cash flow is?
No, what IFRS will do will begin to highlight there's only one analyst covering this story, which is one of the reasons it's inefficiently priced in our view. It will begin to support and validate, in our opinion, the net asset value, which this particular analyst quotes as north of $23 versus its 12 and change share price. So you'll start to see the company reporting its market value based on IFRS, at least the income property portfolio component of it, more on its market value as opposed to, I mean, they built a lot of these things. They're on their books at very low values that do not reflect the current market value.
What's the long-short position? We're talking about a lot of stocks that you like. So are you way off on the long end of the spectrum?
We typically have a short position between 5 and 20%. We often use our short position not to make speculative bets, but to hedge in the true sense of the concept. Last year, one of the trades I think we talked about with some of your colleagues is we were long H&R and short CREIT, two very liquid, long-standing companies, just valuation inefficiencies. Today, we are short in the United States. We're short U.S. against Canada, and we see that the...
Across the board or real estate?
Real estate.
Okay. Mm-hmm.
And we just see the opportunities, the risk profile being much more compelling in Canada than the United States. I mean, we now have employment levels, a key driver for real estate, that are back to where we were before the recession started. And
do you have any comments on this foreclosure issue?
Not really. We're not actively involved in the single-family residential area. It sounds like another bureaucratic nightmare down in the United States. Again, speaks to the risk, why we have stuck to Canada, notwithstanding we have flexibility to invest globally.
Jeff, great to have you in. Thanks for joining us.
Thanks very much.
We're joined by Jeffrey Olin. He is the president and CEO of hedge fund manager Vision Capital Corporation.